Alright, what's going on YouTube? Welcome to my channel, and today I'm going to be doing another Investing for Beginners video, specifically talking about why investing in individual companies with the goal of building long-term wealth is generally a horrible strategy for the average retail investor, and what they should be doing instead. Now, this channel is very much geared towards people who are starting out in investing and just want to understand how it all works, as well as the experienced investors who are just interested in some facts and maybe need to be reminded of them from time to time. And this video might be slightly controversial. I'm sure I'm going to rustle a few jimmies out there because I think a lot of people have built online communities geared towards picking individual stocks. But I still think it's a very important video and it needs to be addressed because lately I've been seeing a lot of new investors going the route of investing in individual companies. So I'm going to be going over why investing in individual stocks for the long term is a bad idea for new investors who are just starting out to seriously invest. Now, I want to start this video with a quick disclaimer. I know some people who get started out in investing, they just want to put a couple hundred or a couple $1,000 in some cases into companies they like, not necessarily companies they've thoroughly researched and have reason to believe are undervalued in the marketplace and are good long-term investments, but just companies they personally like, whether it's a shop they frequently shop at, a video game company they like, or a tech company where they really admire the CEO and treat them like a cult leader. And yes, I'm looking at you, Tesla fanboys. And all that stuff is fine, as long as you recognize that it is an emotional investment and it's highly speculative. And ideally, you should be able to afford to lose your entire investment, and you won't need to sell it prematurely. Like if you have a credit card payment that's coming up and you invested too much money, so now you need to sell your investment so you can make the payment or some sort of bill payment. So if you're not in that boat, then hey, all the power to you. It's capitalism. You can do as you please. But if you're allocating a significant portion of your investment portfolio into just one company that you haven't thoroughly researched, then I'm here to tell you that you're making a mistake. So when you're first starting out investing, it's best to take a buy and hold approach, and you should be looking at either a total stock market ETF or an S&P 500 index fund, or if you live in Canada, a TSX index fund. And your approach should be to invest in increments. So ideally, you want to take a specific percentage of your paycheck that you can afford to put away and you won't need to withdraw back anytime soon, and just hold it for as long as you can. I'd recommend going with Vanguard for the ETFs. They generally have the cheapest ETFs out there that from what I'm aware of in Canada at least. And they're very cheap. You probably won't even notice that they're taking any fees. And you're diversified, which means you own every major company out there without having too much exposure into one specific industry. So say if a giant company, like we'll take JP Morgan Chase for example, if they went belly up tomorrow out of nowhere, you'll be fine because in the long run, they only represent a small portion of your portfolio. So you will notice it in the short term, but over the long term, it doesn't really make that big of a difference. And that's what diversification is. So there was an interesting study done recently by Fidelity where they were looking at which of their accounts had done the best financially. And what they found was the ones that had done the best financially were the ones that were owned by either someone who had actually forgotten that they had a Fidelity account or someone who had passed away. And I find this very striking, and it really helps me illustrate my point, which is the longer you hold on to your investments, the better you will perform. So trying to buy individual companies in a short-term or medium-term time horizon to beat the market is a loser's game. And if you look at the historical returns of all the asset managers out there, all the hedge fund people out there, people who are paid to do this full time and have decades upon decades of experiences, they do this type of stuff for a living and they manage millions of dollars worth of their clients' wealth. They can't even beat the market consistently. And you know who can beat the market consistently? Literal monkeys, guys. So yes, all you Wall Street bets folks out there who love calling yourselves apes, you're really giving yourself a compliment. Because if you ask an ape to just take darts and throw them at a dartboard to pick stocks, they'll even be able to beat the market in some cases. So that's why trying to pick individual stocks is a loser's game. Certainly not something the average retail investor out there should be trying to do, especially when they're starting out, because beating the market consistently over the long term is extremely unlikely, and you are better off just putting your money in a diversified portfolio, setting it, forgetting it. And something else you have to consider is the opportunity cost of your time. If you're going to invest in individual companies and actually take it seriously, meaning you're not just going to randomly invest in a few companies and hope they do well and then brag about how much money you made if you do end up making money, you're going to have to spend a considerable amount of time reading 10Q filings, reading annual reports, looking at ratios, evaluating management, looking at industry trends, and just generally babysitting your investments over time. And even if you do all that stuff right, you can still lose money because the markets are just so unpredictable. And what's even worse is even if you're right about your investments in these individual companies and they go and they increase in value, and the increase in value was less than the market as a whole, it's just not worth it in that case. I don't care what anyone says, guys. You wasted your time because you could have just not done any work. You could have put all your money in an index ETF and you would have had more money at the end of the day. Now, I will say that some people think of investing as a hobby and they actually enjoy learning about companies and evaluating business strategy and looking at management and understanding the intricacies of how you analyze financial statements. And they want to invest in individual companies that they believe in and that they've researched and they enjoy doing this. And yes, if you do this right and you're a little bit lucky, because you need to be lucky, you can make a lot of money doing that. I mean, just look at someone like the Roaring Kitty on YouTube. I mean, obviously that's a very, very unusual scenario, but if you're lucky and you're smart about it, you can make money doing that. But also, by the same token, let's say you spend 5 to 10 hours per week outside of your normal 40 to 50 hour work week. So this is time you're spending away from your family, away from your friends. It's time you could be spending relaxing or working out or learning to cook or whatever it is you want to do. And say by the end of the year, you only beat the market by 1%. Is it really worth it in that case? Is the time investment and the opportunity cost of your time being away from doing other things that you might want to do more worth an extra 1 or 2%? Now, some might say yes, but I would argue that it isn't. But you can make the case that it is because if you say, well, if I can beat the market by 1 or 2% consistently over the long term, then that's going to be pretty valuable because that compounds pretty quickly. And yes, you're absolutely right. But the problem is, it's unrealistic to assume that the average retail investor can do that. But remember, guys, some people do this for fun, and some people do this to learn about companies, and that's fine. Okay, I have no issue with that. People can do what they want. But like I said, for the average retail investor out there who just wants to build long-term wealth through investing, you're better off going with a total stock market index ETF, an S&P 500 index ETF, or if you live in Canada, a TSX ETF, and getting a maximum diversification, even if you literally have just $100 to invest. So if those are your goals, you have to drown out all the noise out there of people pumping up their investments or bragging about how much money they made on some stock, and then obviously not telling you about how much money they lost on another stock because people don't do that. Like, for example, one stock that's getting pumped quite a bit lately is Alibaba. So right now, Alibaba is extremely, extremely speculative. I mean, just look at how volatile their stock has been over the past. And also keep in mind, they're competing against Amazon, who traditionally hasn't exactly been the best company to compete against. So I'm just going to put that out there, not going to go too in depth on Alibaba. But if you're an average retail investor and you're thinking of investing in Alibaba stock, I personally wouldn't recommend it, guys, because unless you're prepared to stomach a short-term decline in stock price, which most people are not, to be honest, then there's a good chance you're going to sell them prematurely and lose money or underperform the market. Now, can you make money investing in them? Yes, absolutely. It's 100% possible. I'm not saying Alibaba stock is going to tank. They could very easily go up 100% next year. But just as easily as they can do that, they can also go down, guys. So the risk is just not worth the reward. And again, if your goal is to build long-term wealth, you need to avoid taking excessive risks like that when it comes to investing. So another rebuttal some people might have is they'll be like, well, look at this. 3 years ago, I invested in Netflix, I invested in Microsoft, I invested in Apple, and I've since tripled my investment. So beat that. And I would say to them, congratulations. But if your goal is to build long-term wealth, you're not doing it properly because you're only looking at it with a 3-year time horizon, which is still considered very short term. My advice to you is to sell those stocks, take that money and go put it in something else. Because what a lot of people do after they make gains like that, if they are even lucky enough to achieve such gains, is they think they're hot stuff and they're going to go try and find the next multi-bagger that's going to triple their investment again. And they either end up losing money or just underperforming the market. So, like I said, it's unrealistic to assume that the average retail investor can consistently beat the market over a long term time horizon, meaning 30, 40, 50 years, by picking individual stocks. It just doesn't happen, and it's not worth the time investment. So I'll talk about some of the data that I have pulled up on screen here. So here you can see I have the historical annual returns of the S&P 500 index, which is a very common index that a lot of investors like to invest in. And as you can clearly see, it's all over the place. So I'll zoom in here so you guys can see. So it's not just a steady incline kind of over the long term. It goes up a lot, it goes down a lot, it goes up a little, it goes down a little. And as you can see here, I've charted the top 5 highest single year returns, as well as which year it happened, and then the top 5 worst ones, just to kind of illustrate the point that these things vary in the short term very much. But as you can see from this, there's more green than there is red. So generally, if you hold for a long enough period of time, you're pretty much going to do all right. And then here, this graph here, this is just an inflation adjusted chart of the S&P 500 index. And then these gray areas, as you can see, kind of represent certain recessions that happen. So this here would be COVID. This here would be the 2008 financial crisis. This one would be the internet boom. And then this big one here would be the Great Depression. And then down here, we can see what a $1,000 investment in the S&P 500 index fund would be worth today. So, and then I've got the annual return as well, which I've put in green so you guys know that it's good. And it's pretty incredible to see how much it's grown. I mean, I have kind of the start of each decade as well as some specific dates that are of interest. So, for example, the lowest point during the Great Depression, this would have pretty much been the best possible time you could have invested in the S&P 500 index, kind of like the cheapest you could have got it. But obviously, I imagine not many people watching this video have been around since 1932. So it's more just for your interest rather than relevant information. But even if we go down here, and if you invested in it at the very height of the internet bubble, meaning you invested in it and the next day the internet bubble started crashing and stock prices started declining. Now, obviously, the S&P 500 wasn't hit as much by the internet bubble. That was more of stocks that are listed on the NASDAQ, kind of the tech stocks. But even if you look here, like the all-time high right before the 2008 financial crisis, you're looking at a 7% annual return. I mean, that is quite good. So as you can see, even if you invest at a horrible time, still, if you hold enough and you hold for the long term, you're going to do okay, guys. And that's the main point I want to address with this video. So I'll leave you with that. Thank you so much for listening, and until next time.